All right. Good morning, everybody. Feels like Friday. I think we made it. We're seeing this rotation back into small caps again, leading in the pre-market. No expectation, though, that they're going to hold it through the day. Still, for something else to trade, they always do make a little bit of fun. Uh, Solar companies, mining companies, pot stocks, those sort of small cap stuff, always fun. EVs, EVTOLs, why not, right? If you're just looking for something else, get them while they're going. Otherwise, we're basically flat for the US. Japan's down the most, minus 108. Again, just keep your eye on Japan, right? It's a significant change to the global system. And next week, you want to keep your eyes on the gilt markets, Europe, France. Oh man, I think that's going to be a big deal. You guys remember there was a PM that lasted like 2 weeks. She got in and she just made some comment that was taken out of context right after she got in. The whole gilt market flipped on its head, and then she was fired. It was like a flash crash, and it was wild, but it was over quick. We have that sort of threat because they're supposed to be naming somebody, and then by Monday, that person is supposed to have a budget proposal. Talk about putting the new guy on the seat and having them expect to deliver. That's where mistakes can happen. So, at the bare minimum, shop around for uh, a YOLO play on the indexes for Monday expiration. Why not, right? Should be really cheap. Monday option out of the money, couple pennies. And remember, those kind of trades, they are gas station lottery tickets. So don't put a lot of money into it because the chances of success are very, very low. That's kind of the whole point. That most likely it won't pay and you lose $1 or two. Who cares? And if it hits, well, you turn that 3 penny option into, you know, a $20 option. We're still not going to get data that we're expecting. Bonds are up this morning, but we're above that swag lever, that 89 and a half. Back here in September, we actually ran above it for a while and got into all these trend lines and failed out. But since then, we've had that dump. It created a liquidity gap that hasn't been filled. And every time we get above this 89 and a half level, it just gets sold off again. Well, right now we're up there. The day isn't done. The expectation is that we're just going to dump back down again. But if you're using something like OCR type analysis, then we've got a higher high and a higher low established. So we'll see, right? It's a flat 10-year and an upward sloping 20. And we do have that gap to close at basically 90-30. So we'll see. That's the target, by the way, if we can continue this drive. Think about it from like that triggering stops discussion that we've had before, right? Anybody that was trading on this day short, they'd have their stops above that day, stops above this day, stops above this day. So that if we run up and we get into those, that would those shorts who had stops, those would be long trades, adds to the buying, pushes us up to the next level, then the next, and the next. Not crazy excited about that, but bonds going up is not what we want to see. So, especially big changes. The dollar yesterday was really a bully. The rally we saw after 3 o'clock came when the dollar closed at 3, and the relief of that, just getting it closed and removing that pressure from the market. Well, we just popped up like a ball underwater, headed to the surface. Tesla got an upgrade to 509 from TD Cohen. You'll want to read the update. I don't think they gave sufficient cause, but whatever. It's a cult stock. I spent 2 hours today reading this Google analysis hack of Oracle, and oh my goodness, that's a dry read. I didn't finish it. It's a long report. I don't know that I'm going to finish it. I think that's just 2 hours of my life I can't get back. The call and the put wall rolled, not by much, but they did roll. I shared the image. I believe the puts rolled down and the calls went back to where they were. Yesterday they had dropped down slightly. So the calls are just back where they were. They didn't go higher than that. And puts are down a little bit lower than they were. 67.92 cog line has been the overnight line in the sand. We got the volatility trigger underneath us. Then zero gamma, 42 points below. Yesterday worked out pretty good. That was very similar to what I had recommended on big move days, right? I showed this point. These two candles here, they're not exactly a tweezer, which is why I didn't call it a tweezer yesterday. I mean, it is a little bit. It's kind of ugly version of it. More often than not, I've seen those called railroad ties, but the wicks are too long to even be considered that. But the discussion yesterday was if we have a big rally day, that we can have another big rally day right behind it, but we can also just retrace the entire big rally day. That's what we ended up getting yesterday, is a retrace of the big rally day. So Wednesday we rallied pretty strong. Thursday we just unwound it all. And now here we are again, right back where we were in the middle. IX10 inside of a really big range, which doesn't do us any good, inside of last week's range, and still just fighting the system. There's nothing here. The best we can say is that the 10 is still sloping to the upside with the 20. We're back above the 3. They're not even starting to curl over yet. So we're still just in this topping pattern and we're holding out, and that's what we've got. It would be nice if we had more than that, but you know, you got to work with what you got. $71,000 It's a little heavier than what we've been seeing, but it's not extreme. There's no warning there. We have a market maker move this morning, so they are hedging. What are they hedging for? I didn't see anything there that was worth hedging again. And these numbers are in line. So they're nervous about something. Either way, we can see it. They are hedging this. They're always hedged, right? Don't make a mistake about that. They are always hedged. This is additional hedging, like seeing a hurricane coming and calling your insurance company and saying you want hurricane insurance, additional hurricane insurance. So they are protecting against something this morning, and it will be today. This is a 1 day only hedge. So far, we're basically flat, so we don't have much edge on going towards one side or the other. We could hit the upper ADR easier simply because it's inside of yesterday's range, but either one is on the table. They're 50 points away from each other. That's the width of the average daily range. So from where we opened at 6 o'clock last night, 25 points higher, 25 points lower, that's the width of the ADR. The reason we have these yellow lines is instead of splitting the day half and half, what if we just went the entire 50 points in one direction? Then we'd be up here or we would be down here, right? So that's why we call it the ADR half, splitting it in half, or the full ADR, moving the entire distance in one direction. The other day we went the full ADR, right? We went all the way to the edge plus some. The funny thing is the SPX is what stopped, right? We hit the full ADR on the SPX, and that's where we ended up stopping. Like I've mentioned before, when the ES exceeds its ADR, go look at the SPX because the ES gets the ADR in the overnight, but the SPX only gets it after it opens at 9:30. Yeah, I think that's a better representation, really, of tweezers right there. Or maybe this one with the no wicks on it. Either way, it worked out. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. So we don't have an MDP. The channel today is narrower than yesterday, but it's still pretty wide, all things considered. A wide channel implies that if we break out, it doesn't stick and that we just come back in again. Somebody asked me about that yesterday, the wide channel and how we had broke down. Yeah, we broke down, but we didn't break out, right? If you look at yesterday, it stayed inside of the previous day's trading range. And when it did try to break out and run, it failed and it came back in again, which is exactly what that channel says should happen, right? Just keep in mind, these channels don't make price do anything. It just gives us some ideas on what to expect if we do get a breakout. So yesterday, we broke out multiple times. We wasn't able to keep it. And that's what the channel suggested should happen, is that we break out and don't keep it. We still have a wide channel today, all things considered, because it could be so narrow you don't even see a channel, you just see a purple line. That's how narrow it could be, and it's not that narrow. But we're inside of another really wide day, so to get the breakout, we'd have to go all the way down to the low and then go lower than that, or go all the way to the high and then go higher than that. And that's a tall ask just to get to the edges, let alone get beyond that and get a breakout that holds. To the downside, we still have the weekly floor pivot. We tested it back here on Tuesday and it held. On first touch from this distance, it's likely we overshoot it a little, but it holds on the first touch. If we test it again today, then we're likely to break it. But we had fallen so far on Tuesday that by the time we got there, we were pretty much exhausted anyways. We're a lot closer today than we were on Tuesday, and we've already tested it. We don't have an expectation that we're going to go down there and hit it, but if we do, likely we overshoot it, probably get into the lower part of the channel before we find any help. R1 is inside yesterday's price. S1 is outside, so we need an inside day breakout to get to S1. I mean, it's ugly, but OCR, we've got higher highs, higher lows, and the sloping moving averages. A little bit of divergence with that stochastics, though. I'll put a lot of weight into that. Classic distribution at this point. It's been a while since we've had such a nice distribution. We've been getting these double and triple and just floppy mess for weeks. So this is really clean, really nice. And a bit of a warning maybe, or a bit of a tell. I still think 67.50 is the key to all of this, and we need to stay above that level. Below that, we've got 66.50. I still think we're running 50s. Ten-day, 30-minute TPO and volume profile. Point of controls are lined up nice on both of them. We don't really have a classic pattern between these two, but we are expecting that into the new week, this range is going to tighten up considerably. As long as we don't break that 67.50, then 67.50 will be the low of this range by next Thursday or maybe Friday. For each new candle we get on the right, we take one off on the left. So we've got to wipe out these candles through the day today. And then into next week, Tuesday or Wednesday, we'll take these off the table. And that should tighten us up by the end of Wednesday next week. So we'll have a range that looks a bit like this. So we either break to the upside, get into 68.50, or we get to the downside and break 67.50. Having a 100-point range, we haven't had that in a while. Right now, it's like 60 points, but that's what this would be, 60 or 70 points. It's really tight. It's another signal that we're in this weird environment where IVs if you're looking at the options themselves, things are getting elevated, costs skew. But if you go in and you look at different volatility tools, things are still showing low volatility, like an ADR of 50. That's a really low volatility. Or a 30-day window that we were just looking at with a 70-point range. That's a really low volatility. We still have this key line in the sand that we drew from earlier in the week. I'm going to continue to keep that until it gets hit. I thought we were going to get there yesterday, but teaser, we didn't get there. We have a VPOC from yesterday, but it got hit during the kill zone. So while the textbooks will tell you to carry this level forward, I generally only carry it forward if the line hasn't been hit. So I don't want this line because I've got enough pivots. I don't need another one. But the textbooks will tell you to carry that line forward into today's trading, whether it's been hit or not. I just marked it there to show where it is. I'm not interested in it myself, but you know, it wouldn't hurt to mark it if you are looking for a few pivots. Otherwise, this low stands out. It's another really good example where sellers got exhausted and we just started going back up, as opposed to seeing a bunch of buyers step in down here and running it back up. Because looking at these profiles, we don't see a bunch of buyers down here running it back up. You can look across this high, right? When we had buyers that was running it up, and then we got that elevated volume up there, the expectation that we ran into some sellers and they pushed it back down against that level. Elevated volumes across the highs or the lows kind of shows that the other side was willing to battle it out. So it's a nice little example, maybe not a perfect one, but it'll do. As we do on Friday, we want to examine next week's range. This range is not set in stone yet. It's not locked. If we look back at all these previous weeks, these are all locked. Once the new week starts, that line doesn't end, doesn't move, right? But for right now, it's moving. The gray line is where price is. The green and the red line are measurements on volatility. And through the day, this thing will expand wider and narrower. It'll move up and down with price. And then at 4:15 or 4:30, it's going to lock into place and then it won't move. But we can get a little bit of a feel for what next week's volatility looks like by comparing it to the week that we just had. So a little early indication of what to expect for next week. Next week's range at this point is just a little narrower than the range that we've went through. So next week is likely to look a lot like this week, all things considered. It really stands out how little movement we had, right? If you look at the range that we've had on the week, they were projecting the anticipation of big moves, and we got nothing. Well, that doesn't necessarily mean that they got it all wrong. They were worried about something, and it's not a known unknown like FOMC, CPI, PPI, non-farm payrolls. Those are known unknowns. When we get a known unknown type of week, we usually end up with a really narrow range. And that's because they expect those volatility suppressing events to hold price down for a day or two. When it's an unknown unknown, we end up with these big wide weeks where they think the market could react on some unknown, unforeseen event and get a big move out of it. Well, we didn't get it this week, but they're pricing it in the next week too. So it's like they're still expecting this shoe to drop and it hasn't dropped yet. That doesn't mean it's going to ever drop either. They could just keep projecting this and then nothing happens. This volatility range comes from the implied volatility average of next Friday's expiring options. This right here. This number is calculated by looking at all of the trades in the out of the money puts and the out of the money calls and averaging up the implied volatility average of each one of those strikes. So the range is based on trading behavior, right? It's not some theoretical math formula. They go in and trade these options, that jacks the IV up and it increases the IV average. And then that average gets calculated into this range. So if they weren't in there trading a bunch of options out of the money, this would be a narrower range. And they're putting on those out of the money options because they're expecting that the market could make some big moves next week. Just to be fair, they were expecting that this week, and well, we really didn't make any big moves this week, all things considered. We're still above the 10-day, so that's good. There's nothing wrong here with our distance either. We're above 0 and less than 1, so that's a good spot to be. And on the 10-week, we're close to 3% above the 10-week, and that is also not extreme. So, you know, it's not a surprise. We were just talking about how we didn't go anywhere for the whole week. Of course, we're not overbought or oversold. We haven't done anything in a week. But you could look at it another way. We had a really nice run off of that 6,600 area. Well, maybe not quite that low, but we had a nice run off of these lows. A straight shot up, nearly 200 points, right? It was close. And it needs time to digest that. 175 points. That's close enough. So this pause or this digestion after that run makes perfect sense. It's actually healthy to do that. Same thing back here when we had that strong run and then we digested for a week. And then, of course, it tried to get more and we ended up giving some back. But it's healthy to do this. It's a correction, just a correction in time rather than a correction in price. That would be a correction in price. I think a lot of people would get upset over that. That's a nice little TRB back there. So we got to let it play out. GTFO, we got to get out of this range, and there's no expectation that we're going to do that today. Why would we, right? Why would we do that right into a Friday with a bunch of unknowns and a government that's shut down and so many conflicts? And I just don't see where it would come from. Looking at what's down this morning, we got nat gas, China, and really that's it. China, 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 and nat gas. And the Mag 7's down volume is down, but not enough, right? We need a little bit more out of it. And it was down almost, well, it was down 6% in a 5-day period. Of course, it's going to go up a little bit. Looking at what's up this morning, it's a really long list of things that are in the green. But the things that are up more than 0.5% is a really short list. Bitcoin, bonds, metals and mining, uranium. Gold miners are basically there. I mean, it's close enough that you might as well count them. The Mag 7 up volume is up. Over a 5-day period, that's now up 5.5%. So the Mag 7 doesn't seem to have known that we were taking a pause. Chips also up 2.5% over a 5-day period. That doesn't feel overbought, compared to what we normally see. So with these sectors up this morning, we absolutely have the opportunity for a rally day today. I said I don't see it because what would be the drive? The Mag 7 would be the drive. We've got those moving in the right direction. We want to focus on the top three, right? That's the risk on market. This is the risk off down below, midlines in the middle. So you need consumer discretionary, technology, financials, but tech, quote, tech, it's really generic. You can replace that with communications, chips, right? Something like that. You could just swap that one out for something a little more nuanced, specific. But they're all looking good. Consumer discretionary maybe not looking so great, leaning on that 50 there. But the Linreg is solid. The moving averages are spread out nice. The data centers continue to mess with utilities, and I continue to argue this old system is broken, and we need to come up with something new. I've been talking to different analysts about how to resolve this, but utilities don't belong down here anymore. They're connected to data centers now. I don't know how to fix it. I don't know how we would want to fix it, and we'd all have to agree to the fix. That'll be my John Bollinger moment, right? My first book, fixing the growth versus value dilemma. So Bitcoin, bonds, precious metals, Mag 7, and precious metals. Metals and mining and precious metals should be a fun play for the day. Keep your eye on chips and Mag 7. We need them to push to get above half. Now, generally through the day, I tend to lean on this chart right here. I got KRE, which is the banks, rather than XLF, which is really generic and covers too many things like insurance and trading desks and all kinds of stuff. Banks, quote, are just more of what I want to look at. And then mags. You can replace mags with the old NY FANG symbol, but it doesn't work in the pre-market, so I don't like to use the old symbol. You need at least one of these, preferably both of them working in the same direction. So mags are up a little bit this morning. That's what we need to drive. It would help if we have financials with it, or consumer discretionary, one or the other. Tech, something. I mean, they're hedging, but it's not very big at this point. Why even bother if they're not going to get serious with it? All right, so Thinkorswim does a decent job with pre-market stuff. TrendSpider and TradingView are, in my opinion, a better vehicle. Get that work done. You can see precious metals over here are up more. It's just a code function of the way that Thinkorswim sees pre-market stuff. So silver leading in the group, unless you're looking at gold futures, uranium, Bitcoin, then miners, utilities, but then we're below the half. So it's a really long list of things that are green. Just none of that counts, in my opinion, until it puts in enough work to show up above half. But we do have things moving in the right direction, except for bonds. That's definitely not moving in the right direction. We need the dollar to calm down. But we don't want fast moves. So while we want the dollar to come down, we don't want it to just crash and burn. Need nice and easy. It's called the rate of change is what we're looking at. It's one of the oldest indicators that exists in the market. I'm pretty sure rate of change was developed as the first indicator before moving averages were, as far as I know. The rate of change in this move, we don't want it extreme. So we want to get back below 99 and then work on 98.5 and then, back to 98, preferably over the next 4 or 5 days, not in a single shot. So if this gets back above the high that we set yesterday, basically that 99.5, look for the S&P and the NASDAQ to continue to be weak and or head down more. We can see the 10-year in the lower part of this range. It wasn't able to get through there. So now we've built this new smaller range and we're less than half on that range. Looking to get back into this low 4.07 and then below that. That would continue to push bonds up, and we don't want to see that, right? So we want to see this normalize, maybe catch some support here, begin working its way back up towards 4.18, maybe 4.2, just kind of calm down a little bit. Not moving would be great. So if we just stay right here in this range and we don't do nothing, that would be really good. We'd take that. And crude looks like it wants to fall out of bed. We've got this key level down here, 60.40. Watch this to see if we get a true double bottom bear trap, or if we bounce on that level and set an inverse cup. See if we get a handle on that cup and then run it to the downside. Can you imagine oil per barrel at 58 or 57.5? Rigs would be hitting the dirt if it was back in the day. Of course, now, so much has changed and we export. But when I was working on those rigs, they'd be stacking them in the dirt. All right, we haven't made it back up to where we were for the kill zone. Look to get that closed. 67.92 cog line. It's also the Globex high. GTFO, like it always is. Break our high to test the ADR half, then test yesterday's high, then the full ADR, which is a cog line 68.32. Level by level. 1, 2, 3, 4. If we do get up that high, look for 68.11 cog line or the Globex high of yesterday, and then map out a 111, 1, 2, 3, 6. I don't think I caught that low perfectly, but that's all right. It'll work. That would be your higher levels to get you from yesterday's high to the full ADR. At least you got some stopping points in the middle there. Otherwise, if we reject this Globex high and we retest this low, then we've got yesterday's low, the ADR half, a 1, 2, 3, 6, and 111 down here, and then the full ADR, 67.32 cog line. down here. I'll keep arguing, why would we, right? My base case argument is we just stay in this and we don't do anything else for the rest of the day. Or if you wanted a little more prescient, then we stay within that. That's the ADR lines. If we get some shock and awe or headline or something, whatever it is that they're scared about up here, that they're hedging, then we could easily hit these ADR lines. Easy, right? If things get wild, take that ADR and double it. So if it says 50, we could go 100 in a single direction. That's nothing. That's a 2% move is your default. So you're looking at 69.11 cog line to the upside. Or 66.50 to the downside. A 2% move, that's nothing, guys. Lock limits kick in at like 7 something, and we've triggered those before, right? We have them for a reason. So that's what I got. Nice and easy. Expect we just go sideways into the weekend. Keep what we got. Don't give anything back. Hold this range and see what we got. Everybody, enjoy your weekend. Be careful. Be safe. I'll see y'all Monday.